Hello, Sense Business YouTubers. How are you doing? Today we'll be covering 5.0 Financial Information and Decisions, IGCSE business topic. So, please join me and I will make sure that you get that A star you deserve. So, today's lesson's outcome is that we will talk about need for business finance. So we'll talk about the main reasons why businesses need finance. We will understand the difference between short-term and long-term finance needs. We will also talk about the main sources of finance. So internal sources and external sources. We will also talk about short-term and long-term sources of finance. We will also understand importance of alternative sources of capital and the main factors considered in making financial choices. Great stuff. So the first topic we'll be covering is 5.1. Business finance, needs and resources. Great stuff. So, why do businesses need finance? So, businesses need finance to start up the business. So, the very first reason might be that to start up a business. So, businesses need money to buy land, premises, equipment, and advertising. So, that is why businesses might need finance. So another reason might be to expand. So expanding the business. So businesses need money to expand, buying more land, to expand factory, or to buying new shops or upgrading machines. So here is another reason why businesses might need finance. So running the business, so the actual running, the day-to-day activities of the business might be another reason why businesses will need online. So money is required to pay for day-to-day expenses. This is also known as working capital. So businesses need money to pay for day-to-day expenses such as employee wages and salaries, purchasing raw materials, and so on. And that is why they need finance. Okay, so what is the difference between short-term and a long-term finance? Okay, so long-term finance means or is long-term finance means finance that is available for over a year. So anything that's more than 1 year is a long-term finance. When a business borrows money from a bank using long-term finance, it expects to pay back the loan over more than a 1 year period. For example, this might include making payments on a 20-year mortgage. So that is a long-term finance. So capital expenditure is the money a company spends to buy, maintain, or improve its fixed assets such as buildings, vehicles, office equipment, furniture, machinery, software, or land in order to increase the capacity or efficiency of a company for more than one accounting period. So this is important and you need to understand what capital expenditure is, because this will probably come on your exam. Now then, what is short term of finance? Short term of finance refers to finance that needs for a small period, normally lesser than 1 year. So long term is for more than 1 year, and short term finance is for lesser than 1 year. This type of finance is normally needed because of uneven flow of cash into the business. So we can say that it is working capital for day-to-day operation. You understand what the working capital is? We spoke about it earlier, so well done if you still remember. Revenue expenditure means the amount of money spent by a business or organization on general operating costs such as rent, insurance, heating, maintenance, for example, salaries, maintenance of office building. So that is what revenue expenditure is. Again, you need to remember what revenue expenditure is and their examples because they are probably going to come in your exam. Okay, so now we're going to move on to our next topic. That's 5.1.2, the main sources of capital. But before I move on to that, I've had a student asking the following questions. So they are saying, "Dear YouTuber, I'm an IGCSE student from China. Your videos can help us a lot, but most of us cannot afford the amount of VPN. They are all quite expensive to Chinese students. Can I upload your videos into Chinese video website like youku.com? Thank you very much. I don't mind you sharing my videos anywhere on earth. And first of all, hello China. Thank you very much for watching my videos, and I hope you get the highest grade possible because that is what this channel's purpose is, to make sure that all students get a star. So I wouldn't allow anybody upload my videos to other networking channels. However, I suggest to Mike that you share my videos. So if you go onto YouTube, there's an option where you can share the videos. So you share the videos on all networking instead of re-uploading it, because sometimes there is legal issues, and you being a business student, you should know about copyright laws and so on. I don't want you to get into trouble from YouTube or anybody, so let's stay on the safe side and just share the video instead of uploading it onto other websites. Okay, so sorry, let's just go back. So we will be talking about the main sources of capital. So what are the main sources of capital? We have internal sources of finance. What that means is, instead of borrowing from investors and bankers, your business has the option of using its own money to finance its operation. This approach can save money on interest payments and free your company from being accountable to outside parties. So that's quite a big advantage of internal sources. So there are various sources of internal finance for the business. This includes the owner's investment, so that is the owner's or the person that owns the business personal money, retained earnings, sale of stock, sale of fixed assets, utilizing working capital more effectively, debt collection. We have spoke about these in previous videos, so make sure you watch them if you haven't already, so that you understand what each of these means. Okay, here are some types of internal finances that we are going to explain in a little bit more detail. So retained profit means profit that is generated by a company that are not distributed to stockholders, shareholders as a dividend, but are either reinvested in the business or kept as a reserve for specific object, such as to pay off a debt or purchase a capital asset. So retained profit is money that's taken from the profit and put aside for a time that a business will need it the most. So the advantage of this is that it does not need to be repaid. They are not borrowing money. It is just the money that you have made. It's the profit you're putting it on side for the rainy day, as we would say here in England. Okay, so profits may be too little for what they are planning to do. So sometimes if you need 10 million for expansion but only have 1 million, because you're not going to have a lot of, you're not going to put away a lot of your money as a retrained profit. So the other option is that selling existing assets. So businesses can sell unused assets such as used or old machinery and unused buildings. So the good side or the advantage of that is that debt does not increase from this. So you're not increasing your debt, you're just selling your things and getting the money for it to run your business or to help you expand. So it takes time until you get sold. So if you have lots of products to sell or a building or lots of machinery equipment, it will take quite some time to sell it for a reasonable time. Or you might be able to sell it at a cheap price but quicker. And that's not what most businesses want. So assets will be sold at a low rate. Anything that you buy new will not value the same the following day. So everything that we purchase, the value drops day by day. So that is the same for business. So all their equipment they have bought will be sold at a lower rate. Selling inventory. So business can sell their inventory for a lower price. This is any item of property held in stock by a firm, including finished goods ready for sale, goods in process of production, raw materials, and goods that will be consumed in the process of producing goods to be sold. So that's what inventory is, anything. So the whole goods in the process of production, raw materials, all that is inventory. The good side to this is that this will help lower storage costs. So you will have a smaller warehouse and sell off all your raw materials that you have got there stored for no reason, or your buffer stock, everything you can sell that off your inventory to create more space, and you will not need to pay this warehouse costs, and you'll not have to pay the movement cost, because if you have lots of stock it will mean that moving it about you need staff to do that, so you reduce all that by selling your inventories. So opportunity cost of actually selling it to the customer for higher price. So the downside is the opportunity cost of actually selling that product or the raw materials to a customer by a higher price. Okay, so external sources of finance. This is finance that comes from outside the business. It involves the business owing money to outside individual or institutions. So as a business can obtain external sources of finance from or by selling shares, bank loans, government grants, debt factoring, and bank overdraft. So these are some places a business can get their external sources of finance. And you will need to learn that because they will most possibly come in your exam. Okay, here are some type of external finance that we are going to go into more detail so that you understand them better. So selling shares. So shares represent ownership of a company. When an individual buys shares in your company, they become one of its owners. So shareholders choose who runs a company and are involved in making key decisions, such as whether business should be sold or not, and so on. So the good side to this, capital rise does not need to be repaid to the shareholders. So if the company goes bankrupt, you do not need to pay anybody because they are risking that money into the business. So no new debt. For example, loan would mean paying back with interest, but where shares, you do not need to pay any interest on that. So shared risk. If I said earlier, so if a business fails, you do not have to give the money back to the shareholders. So that's an advantage. The downsides are that shareholders will be expecting profit to be shared with them as dividends. Loss of ownership, so you will not have the ownership of the business anymore. Loss of control, you will not have control over the business. So some type of external finance, so bank loans. So here's another type that we're going to talk about. So bank loans, borrowing money from the bank. So it is fast source of finance. It is flexibility, so that with bank loans you only need to worry about making your regular installment payments on time. So you don't need to worry about anything. You just pay your monthly payment and that's all. Cost effective in terms of interest rates, bank loans are usually the cheapest option. So the downsides are you have to be repaid with interest. So if you get 1,000 from a bank, you might have to pay 1,200 or 300 depending on your interest rate. Irregular payment amounts. If you get a bank loan with variable interest rates, the rate changes with the market condition. This makes it difficult to determine the exact amount of future payments, and it might mean that you will have to pay lots 1 month or 1 year, and then you might have to pay less on the next year. So here are some other types of external finance that you need to know for your exam. So government grants. Governments may give businesses a sum of money in exchange for benefiting the country. For example, locating factory in an area of high unemployment or to upscale workers. So government might offer some grants. And debt factoring means debt factoring is the process of selling your unpaid customer invoices with the aim of getting the money in much quicker than if you waited for the customer to pay. So the debt factoring company will pay you the money, and you then they will go ahead and start chasing your customers for the money. So the benefits of this is that receive money quickly. You receive your money quickly, improve cash flow, shorten the cash cycle. The disadvantage is with debt factoring is that the business won't receive 100% of its debt they are on. So if somebody owe you £100 and a debt factoring company gets involved, then they might take 20% of that and you will be left with £80. So you'll only get £80 instead of the £100 that the customer actually owed you, because the £20 will go to the debt factoring company. So the risk of harming customer relations. So you might treat customers nicely, but the debt factoring don't care about how they treat your customer. They just want to get the money out of them. So they might use some sort of techniques that will upset your customers. So alternative sources of finance. So we have talked about internal and external sources of finance, and now we are going to talk about alternative sources of finance. So there are two types: macrofinance and crowdfunding. So microfinance is a financial service that offers loans, savings, and insurance to business persons and small business owners who don't have access to traditional sources of capital like bank or investors. The goal of macrofinancing is to provide individuals with money to invest in themselves or their business. So that is what you need to understand for macrofinance. And for crowdfunding, you need to understand is the use of small amount of capital from a large number of individuals. So that's what crowdfunding is, to finance a new business venture. So crowdfunding makes use of the easy accessibility of vast network of people through social media and crowdfunding websites to bring investors and entrepreneurs together. So if you do get an question in your exam about alternative sources of finance, you can talk about macrofinance and crowdfunding. So these two are your main topics to get good marks if you are asked about alternative sources of finance. Okay, so factors considered in making financial choices. So here are some factors that are considered when making financial choices. So businesses put into consideration factors such as purpose, time, amount, how quick the money is needed. So the cheap option available, legal form before choosing the sources of finance. So if you are asked an exam about factors considered in making the financial choices, you could state these. So you could say the purpose, the time, and the amount, how quick the business needs the money, and what are the cheapest option available for them, and what are the consequences of them. For example, a business that needs cash immediately will need to use short-term source of finance, or a business buying land will use long-term source of finance to get a mortgage for 15 or 20 years. Do you understand how the factors change in the choice of finance? So if you're looking for a long term, then you'll get a long-term mortgage, or from a bank you'll get a loan. But if you're looking for a short term, you might just get a quick overdraft, which won't cost you that much money. So it all depends on the purpose, time, amount, and how quick the money is needed. Hey, we have finished. So thank you very much for watching. Is there any question? If there are, please write them in the comment section below, and I will be more than happy to answer them. The next video will link to the next video will be somewhere here. Please make sure that you like, share, and subscribe to this channel so you get updated with the latest videos. Also, I'm giving away one iPhone. Please make sure that you comment and I will select a random person. I've explained why I'm giving this iPhone in the last 4 or 5 videos, so make sure you watch them to understand why I'm giving away this free iPhone. So for now, take care, and I wish you get an IGCSE A star plus. So I hope you get an A star in your IGCSE subject. My head is going dizzy because I've just looked at screen for nearly 22 minutes. So well done guys for staying with me in this class. Let's join me on the next class so that we understand everything there is in IGCSE and we get the highest grade possible. Yeah, so make sure you subscribe, comment, and share this video with all your friends so that everybody can get good grades. Well done guys, and see you on next video. Bye.